1. Start with energy, explain with authority, highlight with emphasis, end with warmth. 1.02 USD, up 0.033 or roughly 3.38% on the intraday session as we watch the tape on this Monday, December 1st. If you are looking at that green percentage and feeling a flicker of hope, I need you to pause and take a deep breath. Seeing a stock like Beyond Meat, a company that was once the darling of Wall Street, trading at over $200 a share, sitting here at $1.02 is a sobering experience. It is a visual representation of one of the most brutal bubble bursts in modern market history. The expectation from the retail crowd, the bag holders who have averaged down from $50 to $20 to $5, is that today's 3% bump is the start of the reversal. They expect that the plant-based revolution is simply on pause, and that eventually the world will wake up and realize they need to eat less meat, sending this stock back to the moon. The reality, however, is far starker and requires a cold, surgical look at the balance sheet. Today's movement isn't a fundamental repricing of the business. It is a technical fluctuation in what has effectively become a penny stock option on survival. We are not trading a growth company anymore. We are trading a distressed asset that is currently navigating the most dangerous financial tightrope imaginable. The reality is that the good news driving this stock right now isn't about selling more burgers. It is about the fact that they didn't file for Chapter 11 last month. The company has engaged in a massive, complex financial engineering feat, the debt restructuring, that has bought them time, but at a cost that most retail investors do not fully comprehend. Let's dissect the price action at 1.02. This level is critical. We are hovering just above the Nasdaq's minimum bid requirement. The psychological war being fought at the $1 line is intense. If you look at the Level 2 data on your Fidelity trading platform or your Interactive Brokers account, you will see massive walls of buy orders at $0.99 and $1. These are not necessarily believers in the long-term vision. These are algorithmic traders playing the delisting defense trade. They know that management will do everything in its power, including the reverse stock split that was approved by shareholders in November, to keep that price above $1. So you are seeing a synthetic floor being defended by corporate desperation and algorithmic scalping. Now let's address the elephant in the room, the recent shareholder meeting and the dilution tsunami. The expectation was that Beyond Meat would run out of cash by mid-2026. The reality, which is partially fueling this stability at $1, is that they executed a debt exchange that kicked the can down the road to 2030. But the cost was astronomical dilution. They issued over 300 million new shares to bondholders. Think about that number. If you owned the stock before this exchange, your ownership stake was effectively incinerated. The pie got drastically larger and your slice became microscopic. This is why the stock is not rallying 50% on the news that bankruptcy is off the table for now. The market is trying to digest this flood of new equity. While we analyze this, I want you to look at your own portfolio strategy. Comment below if you are holding Beyond Meat as a lotto ticket for a buyout, or if you legitimately believe the company can turn a profit in 2026. I want to know your thesis because the math is getting harder to justify. To understand why 1.02 is the current equilibrium, we have to look at the Beyond IV product cycle. The launch of the avocado oil-based burger was supposed to be the catalyst. It was designed to answer the critics who said the product was unhealthy and processed. The expectation was that a cleaner label would bring back the health-conscious moms and the whole food shoppers. The reality, evidenced by the Q3 revenue drop to $70.2 million, is that the consumer has moved on. The issue wasn't just the oil. The issue was the price and the novelty wearing off. Inflation has killed the premium alternative market. When ground beef is $5 and Beyond Beef is $9, the average family chooses the cow. The economic reality of 2025 has crushed the premiumization thesis. Let's talk about how this stock is being traded on platforms like Robinhood stock trading apps versus institutional desks. On Robinhood, you see a lot of dollar cost averaging discussion. People see a stock that used to be $230 trading at $1 and think it can't go lower. That is a dangerous fallacy. A stock can always go to zero. On the institutional side, looking at funds that manage Fidelity mutual funds or Fidelity ETFs, the position has largely been liquidated or moved to the distressed credit desks. The people trading this now are not the growth managers. They are the vulture investors and the volatility arbitrageurs. They are trading the spread between the equity and the convertible bonds. This brings us to the reverse split dynamic. Shareholders approved this measure recently. It is a tool to artificially inflate the share price to meet exchange listing requirements. If they execute a 1-for-10 split, your 100 shares at $1 become 10 shares at $10. The value doesn't change. But historically, stocks that reverse split tend to sell off immediately after. Why? Because it's a signal of weakness. It screams, we couldn't get the stock up organically, so we're using accounting tricks. Short sellers often pile in right after a reverse split, betting that the stock will drift back down. The fact that the stock is up 3% today might be some traders front-running the official announcement of the split ratio, hoping to catch a quick squeeze before the inevitable post-split fade. We must also discuss the competitive landscape because it has shifted dramatically. A few years ago, it was Beyond versus Impossible. Now the refrigerated aisles are shrinking. Supermarkets are allocating less shelf space to plant-based meat because the velocity, sales per square foot, isn't there. If you are using SoFi Invest to track sector trends, you will see that the entire food tech sector is in a recession. The expectation was that plant-based meat would follow the trajectory of plant-based milk, almond milk, oat milk, which captured 15% of the dairy market. The reality is that meat is different. Milk is an ingredient. Meat is the center of the plate. The cultural barrier was higher than anyone anticipated. Beyond Meat is now fighting not just for market share, but for the existence of the category itself. However, let's look at the contrarian bull case, because at 1.02, the risk-reward profile changes. If the company is valued at roughly $700 million, market cap varies with the new share count, and they have stabilized the cash burn. Is there value? The reality that could surprise the bears is the McDonald's McPlant wildcard or a strategic acquisition. If McDonald's were to roll out the McPlant globally and permanently, a huge if, the volume would solve their capacity utilization issues. Right now, their factories are running under capacity, which kills margins. High volume fixes that. Or consider the acquisition angle. A giant like Tyson or Nestle could buy Beyond Meat just for the brand and the IP. They wouldn't pay $200 a share, but they might pay $2 a share. If you're buying at $1.02, a buyout at $2 is a 100% return. That is the gamble keeping the price alive. Let's look at the cash burn metrics from the last quarter. They lost over $100 million. A significant chunk of that was non-cash impairment charges, writing down the value of assets. But the operational burn is still real. They are cutting costs aggressively, layoffs, reducing marketing, exiting China. They are shrinking to greatness. The problem is you can't cut your way to growth. You have to sell products. If revenue keeps dropping 10 to 15% year over year, no amount of cost cutting will save the equity. The burn multiple is the key metric to watch. For every dollar of growth, how much cash are they burning? Right now, the growth is negative, so the metric is broken. If you are a user of Schwab Intelligent Portfolios or similar online investing tools, you are likely underweight this sector, and rightfully so. The ESG wave that lifted this stock in 2019 has receded. Investors are back to caring about cash flow and dividends. Beyond Meat offers neither. It offers a story, and in 2025, the market is tired of stories. But let's go deeper into the debt wall. The restructuring deal they signed in late 2025 was complex. They essentially convinced bondholders to trade their debt for a mix of new debt due later and equity. This suggests that the bondholders, sophisticated money, would rather own a piece of the potential upside, equity, than force the company into bankruptcy now and get nothing. That is a vote of confidence, albeit a coerced one. It means that the smart money thinks there is a non-zero chance of a turnaround. They wouldn't have taken shares if they thought the shares were going to